Well, for more on the Groupon deal and venture capital funding, we are joined right now by Kerner. He is Wall Street's first social media analyst. He has covered the group for Goldman, Merrill, and now Wedbush Securities. He's right beside me here in the newsroom. Lou, thanks so much for coming in. So this is the 7th round, right? Series G for Groupon. What are they going to do with the money?
Well, they're going to use a big chunk of it to buy shares back from some of the initial backers who are obviously going to get a spectacular return on the early investment in Groupon. And then they're going to use the rest of the money to fund their operations around the globe. This is a brand new e-commerce category, and they want to be the global leader. And that's going to take a lot of investment around the world.
So it's essentially coming at a pretty busy, hectic time, as you just mentioned, in e-commerce. I mean, are they trying to position themselves, maybe make an acquisition?
Well, sure. They've made a lot of acquisitions around the world. They're trying to buy market leaders in different countries around the world, and I think they'll continue to do that, as well as start operations where maybe there isn't anybody who has a significant lead already.
What about who's beating them as far as going through 7 rounds or more, or raising $1 billion or more? I mean, there's a lot of VC money swirling around, isn't there?
That's right. We actually just did a study looking at social media investment by venture capitalists and saw that in the fourth quarter of 2010, there was $819 million invested in social media companies, and that equaled almost the entire amount of the first 3 quarters, so for a total of about $1.67 billion invested in all of 2010. And we think 2011, already with Goldman's $2 billion raise for Facebook, is going to just dwarf the amount invested in social media in 2010.
So does it just show that social media really doesn't need the capital markets? Does this really just prove the point?
Well, I think it does show that the secondary market, that the private market for these shares, whether it's VCs or wealthy investors, are willing to step up and invest at these companies at very significant valuations.
So it seems like maybe Wall Street bankers should be a little worried.
I still think there are going to be a lot of IPOs in 2011 and beyond, so I still think there are a lot of fees to be made in the space.
All right, Lou, we have to put you on the spot. If you were going to talk about one company, the first company that's going to put out its IPO in this year, what would it be?
It looks like it's going to be LinkedIn. According to reports, they've already hired several bankers to help bring them public. It's a company that's scaling dramatically, that's actually very free cash flow positive at this point, and I think the markets would be very accommodating to a LinkedIn IPO.
All right, LinkedIn IPO, first one of the new year in social media. Lou Kerner, thanks as always, Lou Kerner, joining me right here in the newsroom. He works for Wedbush Securities.